Hey guys, hope everything is going well. Alrighty, I'm almost at 100 subscribers. Get me to 100 subscribers on my finance channel. And hopefully, I could make sure this channel is on the up and up. So, the Federal Reserve yesterday, with Jerome Powell at Jackson Hole, and what happened in Wyoming. So, from my understanding, he said that he's going to not stop raising interest rates. He doesn't want to stop right away just because you've had the last month or two where inflation is still there but not increasing at the same rate. He said that, hey, look, I'm not, I'm still going to be raising interest rates. So there's debate whether he's going to be raising interest rates between 50 basis points or 75 basis points. That's going to happen. And I'm looking at it, okay, right now the Fed funds rate is what? 2.25% to 2.5%. And the 10-year yield right now is 3%. So suppose they raise the Fed funds rate to 3% and have a 75 basis increase. The Fed funds rate is going to be at the same point at the 10-year yield. That, in my opinion, is dangerous for the economy if that condition holds for a longer period of time. And when you invert the yield curve like that, I'm not talking about the 2-year yield versus the 10-year, the Fed funds rate versus the 10-year yield. If you invert that for a long time, you're going to have a lot of issues in my problem. Doesn't mean that the whole system's going to crash tomorrow. It just means that, hey, look, the banks cannot make the same amount of money that they once used to, right? They need to make money when the yield curve is upward sloping. So, in my opinion, the Federal Reserve is going to have to pivot. And they cannot raise interest rates just like Paul Volcker did in the 1980s. Simple reason is the debt is out of control. It's what, over $30 trillion? I believe the debt wasn't even like $1 trillion when Volcker was alive and raising interest rates very aggressively in the 1980s. So I expect Jerome Powell, he's going to be slashing interest rates. I don't know when, but that's what it looks like to be happening. Could be later this year, could be early next year, but either they don't raise interest rates or what they do is they say that we're going to pause with the interest rates. We're going to pause interest rates or we're going to cut interest rates. One of those two things is going to happen for them because the economy, in my opinion, will not be able to handle it long term speaking. Look at the 2006 or look at the 2008 crash, right? The yield curve was negative for a while. And bada bing, bada boom, whole system couldn't handle it. So that's just one thing to know. I expect them to pivot. And right now, they want to convince people that, hey, we're going to be taking aggressive action to manipulate the sentiment of market participants. That's what the Federal Reserve does. They manipulate people, they manipulate the market to be like, hey, this is what we're going to do and this is what's going to happen, right? It doesn't mean it's going to happen, but that's their end goal. I mean, there's papers written on that from my memory. So, Federal Reserve is going to pivot. So, I'm looking at other factors that may be showing why they may be pivoting, or I'm just looking at just some other trends as well. So, firms are starting to lay off individuals, and it's happening mainly in tech, mainly in the crypto space that benefited, and housing. It benefited from the easy money from the Federal Reserve in 2020. And now that easy money has gone away. So they have to lay people off. And that stinks for many people. PWC, they announced PWCC is involved in sports cards. They are an online consignment house. So PwC, PricewaterhouseCooper, the accounting firm, consulting firm, etc., they stated that they're seeing responses from companies saying that, hey, they're going to lay people off, about half the companies out there. That is quite interesting because at my firm, they told me that, hey, they give everyone raises this year because of the ridiculous inflation, and 2, some people were promoted, right? So that's quite interesting. So they gave promotions to people, they gave raises to people, and it's quite interesting, right? In my opinion. So that's why I'm like, I remember 2020, I saw people getting laid off where I was at, and they haven't backfilled those positions, or at least all of them. But it is what it is. So you're looking at the employment situation. If they start laying people off, that could potentially hurt corporate. That could hurt the overall economy. So I believe the Federal Reserve is looking at that. And the minute they see aggressive layoffs, that would give them one reason to reverse course on what they're doing. In addition, I'm looking at the US dollar index, and I'm going off the work of David Brady, a technical trader who uses Elliott wave theory. I'm not a technician, but let's just look at the dollar index. What, close to 108, 109, whatever it is right now. And as I've mentioned before, even though the market tanked on Friday, the overall market hasn't crashed to a significant amount looking at the dollar index, right? A stronger dollar would indicate, hey, a severe, or it's harder for corporate America to make money off their exports. And I believe that a stronger dollar is not in the best interest of the elite. Obviously, I prefer a stronger dollar in a normal situation. Now, we don't live in a normal situation because they printed so much monopoly money. They have created a ridiculous amount of inflation with some of their government policies as well, some sanctions as well. So if you look at the dollar index, I believe the RSI, he calls it, David Brady, a negative divergence, where the RSI isn't making new highs as the dollar is making new highs. And if you're just looking at that from a long-term charting perspective, what is that telling you? It tells you that there aren't as many buyers pushing up the dollar index higher. And because of that, and maybe you'll have potentially news from the Federal Reserve being leaked out or whatever, some Fed chairmen say that, hey, we don't want to go along with more interest rates hikes. Is that going to be the fundamental case for the dollar index to reverse course, to go down? And my thesis all along, even though the dollar index has gone up, from 103 to 108, I'm glad I'm not trading Forex, but if that index goes down, dollar index, what does that mean for stocks, in my opinion? Stocks go up. I believe that gold and silver is going to go up. I believe Bitcoin is going to go up. I believe that longer-term interest rates, like the 10-year yield, is going to go down. And that should temporarily help the economy for the next 1 to 2 years. So if the Federal Reserve reverses course, then I see green shoots occurring. Now, what's the time frame? Is that January? Could be. I mean, I think Martin Armstrong's economic confidence model, early in the spring, you're going to see a bottoming out process. So, and then I think it's a green shoots for a year, according to his cycle. So I'm keeping all these perspectives with an open mind. I'm listening to all types of people, but even though the Federal Reserve hasn't reversed course, I do expect them to reverse course. And that should help out markets, in my opinion, for the next 1 to 2 years, guys. Anyways, let me know what you think. Remember to smash that like button, subscribe if you haven't. Comment down below, guys. Thank you. Bye.